Right. Hello, everyone, and welcome to another session of Cashflow Mastery Talk series entitled Capital Expenditure Decision Making, Maximizing Returns on Investments. My name is Matt from the Insightful Accounting team, and I'll be your host for today. Our speaker is Mike Milan, and he'll introduce himself momentarily. And the floor is all yours, Mike.
All right. So, hey, live from San Antonio, it's Cashflow Mike. It's our monthly cash flow insights, with Insightful Accounting. I'm always excited to work with this one because I don't know. Gary and I, Bob and I, we've been friends for a long time. So I love being with this group. So I'm seeing a bunch of names that I recognize, man. That's a really cool thing to see is some names like Renette and Michael and Marcia, right? We got Linda. Hasim's in there. So Chastity's been to a few things. Catherine, look at that. We got all kinds of folks that I see come back. So I appreciate that. Today, we're going to talk about buying stuff, right? Buying stuff. So let me get my PowerPoint set up and we can get going. So how do we do that? I mean, why do we even buy stuff? But first of all, let me tell you why I do this every month, right? I'm on a mission to eliminate cash flow as the reason that businesses fail, right? That's one of the things that always frustrates me is that a business fails because they run out of money. And they say, well, 82% of them do, or there's all these big statistics. Hey, we're here to stop that. I ask people all the time, I said, what business do you think you're in? And I'm talking to accountants and bookkeepers and bankers. What business do you really think you're in? And I want you, and some of you heard me say this before, I want you to think of yourself as being in the dream fulfillment business, right? That's your job, right? Every client that you have comes to you or starts a business because they've got a dream. Their dream isn't just to have a job. Their dream is to do something else, whatever that is that's next. Your job is to help them get there. So think about it yourself that way. And I think it always makes me happy that I'm helping somebody move towards their dream. One of the things I always point out on this is that bankruptcies are the thing that really I've had friends go through it and it's tormenting, right? Especially a business bankruptcy when they can see profit on paper, but they don't have any cash in the bank. That's the exact type of problem that you and I can solve. So let's do that together. So today I want to talk about buying assets. One of the biggest arguments I ever had with an accountant was my uncle's CPA. We have a family farm up in Illinois, right outside Galesburg, Illinois. And I was back for one of the holidays and we were talking about taxes that were coming up, right? And we're talking about taxes and what was going to happen. And the CPA for my uncle, who, by the way, at the time was like 76 years old, was asked to buy a $300,000 tractor, right? $300,000 tractor. And the reason why was to save about $30,000 or something. I forget the number, but we'll call it $30,000 in taxes. Well, in my mind, it doesn't make sense. Why do you ask a 76-year-old man to buy a $300,000 tractor just so he can save $30,000 in taxes? Because in my mind, the only reason to buy an asset is to generate more revenue or more profit. We didn't get more land, so this tractor wasn't really going to generate more revenue and profit. My uncle liked it because it had an air conditioner in it and his other one didn't. That was the big thing. You're going to pay $300,000 to get something with an air conditioner. Doesn't make sense to me, especially since he's been doing this his whole life. But when you're thinking about buying an asset, I want you to remember this rule. We went over this last week, but I want to kind of expand on it this week, is the length of the loan should match the life of the asset. The length of the loan should match the life of the asset. That means if you're not going to use cash to buy something, I want you to get a loan that matches the useful life. We call it depreciation. So if I can depreciate something for 5 or 7 years, then I buy that asset with a 5 or 7 year term loan. And that way, when depreciation ends, so do the payments, and we're kind of matched up, right? It's a good time to replace, a good time to think about what to do next, but that's how you do that, right? You're going to match your loan payment with the depreciation. That way they all end about the same time. Now, some people ask me, say, well, where does the money come from, this balance sheet thing? Well, I drew this for somebody last weekend. Just drew the way I explain the balance sheet to clients, which is really an interesting thing. So this is, I know everybody on this call already knows this stuff, but I'm going to give you some words to use to explain the balance sheet to a client. So I take the balance sheet and explain it to them and say, hey, the basic accounting formula is that assets have to equal liabilities plus equity. So instead of up and down, I just show it to them side by side, that this side, and when you do this for your clients on paper, make sure you don't abbreviate stuff. So if you abbreviate things, it could be embarrassing. So make sure you write out the whole word if you have to. So it's assets equals liabilities plus equity. And of course, that was a joke. I hope you laughed. It was a joke to me anyway. And equals liabilities plus equity. So these two sides have to equal. And of course, this is liabilities plus equity. Again, that's what I'm trying to do, is explain to a client what this balance sheet is, because they don't know and they're not using it. So assets, who knows in the chat, who knows what assets are? How would you explain that to somebody? Larry, I saw you sneak in there. So Larry knows what it means. It's just stuff I have, right? Just stuff I have. That's all assets are, is just stuff I have. So if that's true, assets, I have a checking account. I have a, people that owe me money. We call it AR. I've got buildings. I got cars. I got, inventory. That's just stuff I have. Well, what are liabilities then? If that's stuff I have, Linda, right? Stuff I buy. You were there last weekend. Liabilities is money I borrowed. Why would I borrow money? To, there you go, Larry, to buy stuff. That's right. Money I borrowed to buy stuff. Then equity. Keep going, Larry. You got it. What is it? It's money I put in. Why would I put money in this company? Yeah, to buy stuff. So this actually helps your client understand the balance sheet. It's the stuff I have and where'd the money come from to buy it. Did I borrow it or did I put it in? So when you talk to people this way, they start to understand, oh, that's why Mike calls it the culmination of every decision I've ever made in this company. It is the living history. It's what I owe, what I own, what I have, all of those things on one document. It never starts over. That's the balance sheet. Well, today we're going to be talking about, how do I account for a capital investment, capital expenditure? Well, since Larry's on our, I haven't put in the chat, right? So, Larry, where do you get the money, or how much can you afford to borrow? Do you know that, Larry? How much can you afford to borrow? And we've talked about that in these seminars before. If you don't know, I don't want people to be embarrassed. I've had clients go into the bank and they go, hey, how much can I borrow? Or they'll say, I need a loan. And the bank will say, well, how much you want? And he goes, I don't know. How much will you give me? We don't want to be answering questions to the banker like that. So if you know EBITDA, I want you to take EBITDA and multiply it by 3. That's going to tell you your long-term capacity, long-term debt capacity. And long-term debt, again, is what we're using to buy stuff, right? When we don't use cash, capacity, that's our capacity. So if EBITDA is $100,000, we can borrow about $300,000, but you can't stop there. You have to subtract whatever is long-term debt on the balance sheet. And that equals your borrowing power. How much power do you have left? So if I can borrow 300,000, but I have 100,000 on the balance sheet, that means I can only borrow 200,000. This is where when you go in and ask for a loan and you ask for $1 million, and after 2 weeks, they come back and say, no, but we'll approve you for 500,000. They've done a calculation very similar to this, where they said, EBITDA times 3 is about what you can afford, but you already have some on your balance sheet. So this is all that we can give you, your borrowing power. That's at least one way to determine whether or not you can buy an asset. So then let's talk about the assets, right? How do I know if I should buy an asset or if I'm coming up on it? We call it capacity in a lot of ways. Let me go back to here. And I use, and you're going to see this in a calculation in my course called Mining Your Business for Hidden Cash. But this is going to tell you if you should be buying assets or not. Sales to assets. This is saying for how much money you invest in a capital expenditure, how much in revenue does it produce? Remember, my first statement in this series was the only reason to buy assets is to generate revenue and profit. So this is going to tell you how much revenue your assets actually produce. So you take sales and divide it by total assets. And in this case, I'll give you a couple of numbers, right? Yeah, right, Larry, cash generating. So if sales is 8.4 million, you know, I'm the type of guy that just leaves the zeros off, makes it a little bit easier math. And I have $4.2 million in assets. My sales to assets ratio is 1.98. Is that good, fair, or terrible? Well, we already know from this webinar series that ratios don't mean anything unless you compare them to something else. But here's what it means. The way you read a ratio is that for every dollar you have in the bottom number, so every dollar I have in assets, it produces $1.98 in sales. So we pretend that this is a 1. I have $1 in assets, and the result is the top. So for every dollar I got in stuff, it produces $1.98 in sales. That's important because a lot of us, when we do forecasting, we just go, oh, I think we'll make an extra $1 million this year. Well, not if you're only doing $1.98 in sales, right? I mean, so a truck will only give you $198,000. But when I said you have to compare it to something else, we got to look at what we're going to compare it to. We either compare it to what we used to do, our own goal, or what we want to do, our own goal, or we're going to compare it to the industry average, right? So in this case, if I look at the industry average, it's 2.3. Now I can actually answer the question, is this good, fair, or terrible? Well, some people go, oh, that's fair, Mike. Okay, I could go with fair, but let me say it to you differently. You produce $1.98 for every dollar in assets you have. Your client or your competitors produce $2.30. So they get $2.30, you get $1.98. So if we go buy a $100,000 truck, you're going to get $198,000. They're going to get $230,000. Which would you rather be? Yeah, most people want to be the industry average at the minimum. That's what you should be, right? You could be your goal, but you should be your industry average. So what I do is that's what this says, right? So for every dollar you invest in capital expenditures, you earn $2.30 in revenue. So here's how you look at this. If you're already over that, if my result was $2.80, I might have to look to add, because this is starting to say that I'm using all my resources, I'm using all my assets better than the industry is. So I'm getting more sales for every asset I have compared to everyone else. That's the time you want to think about adding capital expenditures, right? You want to add a piece of equipment, you want to add a location, you want to add a truck. It's when you're doing better than anyone else, because this is saying that maybe you're going to hit capacity, right? You're going to hit some restraints with what you can produce. You won't be able to grow anymore because you won't have enough equipment. That's one of the ways to look at that. If I'm doing less, hey, we should be able to sell more without adding equipment. So this is kind of the first thing. And remember when we talked about financing a couple months back, we talked about, whether or not, if I need a loan, when should I be looking for that time frame of the loan? It's next year. So when you're having conversations with your clients about should you get a loan next year, this is one of the things you're thinking about is, yeah, you might need a new tractor. Yeah, you might need another line in your manufacturing plant. You might need another location, because if we're going to continue to grow and hit our forecasting goals, we don't have enough stuff. If we're under the industry average, that's telling us we should have enough stuff to buy things. Now, that doesn't mean we we shouldn't replace. If it's broken or if it's obsolete or it doesn't work anymore, you can replace the asset, but it doesn't mean you need it to grow. All right. So when we're forecasting, right? So I teach this thing called forecasting by the numbers. And forecasting by the numbers is about, first of all, the first step is an income statement, just doing your income statement projections. And what you're seeing across the top here is the seasonality, because some people just take their annual forecast, I want to do $1 million, and they put $83,000 a month all the way across. Well, that doesn't show the realism of how sales actually come in. So I always try to add the realism of seasonality to my forecast, right? About how much does it come in? What this doesn't tell you is how much money do I have really to make debt payments? Now, I can start there, right? I can start there with 378. That's part of the EBITDA, right? Then I'm going to add back in interest and taxes, depreciation, amortization. So it's going to be a little bit over 378. And we know that we have 378 times 3. So let's call it 400,000. 400,000 times 3, we got $1.2 million. But that doesn't tell us about making the payment. So the second step I do is this thing called a cash budget. And I'm going to show you in the new app how this kind of works out and can do the planning for you automatically. But in a cash budget, we're going to account for long-term loan payments, right? Some people aren't putting that into their budget. And you don't see this in the income statement. You don't see that you can make the long-term loan payment. And when we've done financing in the past, I've talked to you about, oh, Catherine says, where's the best place to go to find industry averages? Great question. I have a database that I built into my apps. Your bank is a free resource. You can go. They usually have a product called RMA. RMA, you can take, your list of NAICS codes, North American Industry Classification System codes, give that to your banker, and sometimes they'll just print out, the industry averages for your clients. All of the SBDC, if you have an SBDC office inside your town, at the usually major universities, they've got an office and they have access to industry averages. You can also go to like the minority business development centers. Anybody that's kind of a government type agency or a lending type agency has access to this. So if you have a relationship, a lot of times they'll just give you those industry averages. There's not a lot of great resources on the internet that's built into some software, but just like mine, I have to pay for a database, and I buy mine through RMA, the same places that the banks do. Okay, so this is the cash budget, and it's going to tell you when is a good time to make the purchase. Because if I'm going to be short on cash, where I'm negative balances and I got to draw from my line of credit, and I want to try to make a purchase, well, maybe it's better that I move it to a time period when I have more cash. So the timing of not only just doing your forecast, will I generate more revenue with this piece of equipment, but what is the best time to actually make the purchase? And it's usually going to be the time when you have more cash. You shouldn't be making major purchases or taking money out of the company when you're struggling to keep up with the actual business. So let me do this. Let me stop that share and go show you how this kind of works in real life. So I got a couple different things I want to show you. For those of you that are in my community, you might have seen this. I've been showing you a lot of the new updates that are going into the app. But I want to talk about specifically a couple of different things that we use. Now, when you put in, your balance sheet into the app, the ClearPath to Cash app, it's going to sort it into, different things, right? It's going to pick the things it needs for ratio analysis and those type of things. It's also going to talk about how much you have in debt instruments, how much you have in operating expense. But then there's some specific tools that you use, right? Specific tools that you use to, say there's Q&A. Where can I get the slide? Oh, the slides are, Matt has them. I sent them to him today. So he should be able to get those out. It's a PDF form for the slides. Okay, so the thing that we've talked about already, we talked about this thing called mining your business for hidden cash. Larry brought that up. This is, should I buy a piece of equipment? Well, this mining your business for hidden cash technique that I use kind of gives me the first visual indication that they might need to build or buy some more equipment. This is saying where cash is leaking out of the business. But we're going to focus on this one, the sales to assets. So sales to assets, he's currently better than the industry or better than his goals even. Let's see. Compared to the industry, he's even better than the industry, right? So he's outperforming the industry and generating more revenue. That's the first visual indicator that I've got, and I can just turn off the other ones. That he's doing better and have him pointed here. So because we're doing better, that means we are producing more revenue with the stuff that we have. This is the first indication I got to start talking to my client about if you want further growth, we might have to look at buying more equipment, right? So that's the first thing I look at is, do we already have a capacity issue that we're going to bump up against at some point in time? The second thing that I'll look at is whether or not the ratios make sense, right? So current ratio is how much money do I have just to pay for my day-to-day business? How much cash on hand do I have? And I want people to have about 45 days or more. In this case, it's greater than F because they have about 2 days worth of cash on hand. Not a great time to buy a piece of equipment. They also have things like EBITDA as a percentage of sales, how your business runs, the debt load is where I wanted to go next. Now, these are rated A because you don't want to encourage your clients to take on more debt if they're already heavily burdened with it. And the way you can tell is that this is saying for debt to equity ratio, for every dollar I put in the company, I let the bank or I borrowed 89 cents. Now, debt to equity ratio can go up to about 2.5 for banks. That means for every dollar you put into the company, the bank has put in $2.50. That's how you read those. So again, the bottom number is a 1. For every dollar I put in, the bank put in 89 cents. This is actually pretty good. The higher it gets, the less likely it is you'll get a loan. Then we've got, yeah, sure. Then we got debt service coverage ratio. A lot of people don't know what that means. Here's what I'm telling you. You want this number to be at 1.25 or higher. What it means is for every dollar you owe, how much money do you have to pay for that dollar? In this case, they've got $3.76, right? So for every dollar they owe, they've got $3.76 to pay for it. That's kind of how you read that. So that's the second place I look is, are we already heavily burdened with debt? A, should we buy? B, what's the likelihood that we'll succeed if we buy? And then I'll kind of model it out in the forecasting. So I'll go over to the forecasting module and forecasting by the numbers. And this is where I can actually create a simulation, right? So in the forecast, I'll just go to this one that already has a truck built in. In the forecast, I want to go to the cash budget because we're talking about cash. And if I want to try to add something else, this is the cash budget on whether or not I'll have enough cash, ending balance. But see these zeros? I'm going to try to buy something in March or April. And this will kind of give me another visual indication that I shouldn't do that. Yeah, my course does have, if you go through the course and go through the whole thing and take the test at the end, there's 27 hours of CPE credits. So if I want to buy a new tractor, right, it's an asset purchased. Maybe it's going to be that 300,000, and I'm going to put, I don't know, 25,000 down. I'm going to pay for it over 5 years at 10%. I don't know. But it's going to tell you what the payment is because it puts it right into your cash budget, right? So it's not a one-time thing. I'm going to do a recurring, and we're going to try to buy it in March, right? And end in December because we're just forecasting the year. I add the transaction. It's going to put new tractor in here. Now down below, what you're going to see is that I have made a asset down payment right here. And my payments went up the following month to $5,000. And down below, it's got my ending cash at 0, even more so. And I'm having to draw from the line of credit even more so. So my line of credit balance, you'll see it starts to increase because it's going to tell me, hey, if this plan is going to work, you're going to have to use your line of credit to the tune of about $66,000 to meet your goals, right? To actually just pay your expenses and buy your truck to make your debt payments. And in this case, there's no transferable value payment, which means the owner's not able to take any money out himself to fund his future. So maybe this plan isn't going to be great because I'm not going to get any money towards my own goals just this year, the way I'm playing it out. It's also going to say, hey, listen, you're actually maintaining a healthy line of credit that even though you have to borrow $66,000, you'll be able to pay it off and let it rest. That's one of the rules of lines of credit. And we're going to compare all your purchases against, against your cash reserve, which is 3 to 6 months. And if you need some help, I'm going to say, hey, delay non-essential CapEx. So what I'm trying to do is put people in a better position where they don't create a cash flow problem when they want to go buy actual capital expenditures. Remember, the only reason to buy it is to increase revenue and profit. If it's not doing that, then don't do it. If you don't have enough money, then don't do it. If it puts you in a bad debt situation on your balance sheet, then don't do it, right? I'm trying to give you enough little levers that you know what you're looking at, and you don't rely on the banker to tell you everything after you make an application and your client is embarrassed. So I am Cashflow Mike. Let me show you how to learn more about me. Just go to cashflowmike.com. And I've got a free course there. This says free book. I expanded that. It's free course now. You get the 7-minute conversation, which is how to analyze any company in 7 minutes or less using the balance sheet, the income statement, the cash flow statement. I've got a free Facebook group that I do lots of little short videos. And we give out a lot of free resources. So it's called the Clear Path to Cash. That's my program called the Clear Path to Cash. So go join the Facebook group if you're on Facebook. I got a podcast called Mike and Blaine. It's business, beer, and BS. If you want to hear more stories about how we do things or how I've done things, it's fun. It's just a fun, casual podcast if you're a podcast type of person. And then lastly, if you want to talk to me about what I do and how it can help your practice or how you can get that app I just showed you, contact me at mike@cashflowmike.com. So Matt, look at that. I made it on time once again. Right on the money, baby.
That's perfect. But we got one question.
Oh, I missed it. One correct. I saw the CPE and I think I answered that live already. So there is 27 hours of CPE that's offered through my course. You go through the Clear Path to Cash course. At the end, you take the certification exam. It's 25 questions, multiple guess, and you need an 80% or higher. And once that happens, you get 27 hours of credit. Sponsored by NASBA.
All right. Thank you so much, Mike, for another interesting and fun session. And of course, thank you to everyone who joined us today. Have a great day, everyone.
All right.
Goodbye.
Take care now.
Are you an accounting or tax professional who wants to stay ahead without spending a dime? Join thousands who trust insightful accountant and tax practice news to keep them informed and empowered. Get expert updates on QuickBooks, Xero, tax planning strategies, and workflow tips delivered straight to your inbox. Whether you're a solo bookkeeper, firm leader, or tax advisor, these newsletters are your shortcut to what's next in the profession. They're free, practical, and built for people like you. Visit insightfulaccountant.com and hit subscribe to start your smarter workflow today for free.